All right, let's just jump right into it. When the CEO of a challenger brand grabs the mic and flat out says they're stealing market share from the legacy heavyweights, yeah, you've got to pay attention. It's a massive statement. But look, in the world of high-stakes enterprise tech, talk is pretty cheap. What really matters is what the data actually shows.
Because 7, that's the number of consecutive quarters they've posted sequential revenue growth. In a market that's just been battered by supply chain chaos and shifting macro headwinds, stringing together 7 straight quarters of growth is, well, it's notoriously brutal. It tells us that this quote isn't just executive swagger. It's backed by a verifiable, sustained streak.
So, welcome to The Explainer. Today, we're tearing down Extreme Networks' Q2 fiscal 2026 earnings report to see exactly what's under the hood of this growth engine. We're bypassing all the corporate jargon and pulling the hard data directly from their SEC Form 8K filings. If you want to understand how a tech company actually scales in the modern AI-driven networking space, you're in the right place.
Here is our roadmap for the breakdown. We'll start with their sequential growth streak, dive into their SaaS revenue engine, look at the real-world networks they are powering, check in on profitability and margins, and finish up with their future financial outlook. Starting right off with Part 1, the sequential growth streak. And you can see the foundation of their Q2 performance right here. Total net revenue hit $317.9 million. That is a very healthy 14% jump year over year. You've got physical product revenue coming in at roughly $198 million, and subscription and support sitting at about $120 million. So they're definitely shipping a ton of hardware. But that physical gear, it's really just the Trojan horse for their true growth strategy. Moving on to Part 2, the SaaS revenue engine. Now, Wall Street absolutely loves software, right? Because it's predictable. This $226.8 million figure represents their SaaS annual recurring revenue, or ARR. The key takeaway here is that this is effectively locked-in, annualized cash flow driven by their Extreme Cloud IQ platform. Customers are paying a recurring fee to keep their networks running, and it forms this incredibly solid financial bedrock that lets the company invest aggressively. And just look at the gap between these two growth rates. Total revenue grew at 14%, which is solid, but their SaaS ARR shot up by 25.2%. That's nearly double the pace. What we're seeing is a highly successful SaaS transition playing out in real time. As more customers adopt these cloud-managed solutions, the overall quality and predictability of Extreme's revenue just completely transforms. And here's where it gets really good. This transition creates massive operational leverage. Their CFO actually highlighted that earnings are growing a full 10 percentage points faster than revenue. To put it simply, as they get bigger, the cost to deliver that next dollar of revenue actually shrinks. That is the absolute magic of layering a rapidly growing software platform on top of a hardware business. All right, Part 3, powering real-world networks. Because they aren't just selling to small mom-and-pop shops. I mean, look at this roster. You've got the Pittsburgh Steelers upgrading to high-density Wi-Fi 7, Six Flags outfitting their 12th property, SK Bioscience building a new R&D center in South Korea. They are winning massive, highly complex global contracts. These are environments that demand flawless, zero-downtime connectivity. You literally cannot have the Wi-Fi drop during an NFL game or while theme park ride sensors are firing. And what's driving a ton of these massive wins? Extreme Platform One. It's their flagship networking tool. And get this, it actually booked double its internal sales target this quarter. Literally twice the plan. It turns out customers are desperate for platforms that simplify their IT operations. By using AI to automate the really complex tasks, this platform lets a tiny IT team manage a massive enterprise network without getting completely buried in the weeds. But look, behind the flashy logos and those impressive customer wins, we've got to pop the hood and check the actual financial health of the business. Logos look awesome on a marketing deck, for sure, but do they actually translate to a sustainable, profitable bottom line? Which brings us to Part 4, profitability and margins. Okay, notice the sharp contrast here. You've got their standard, strictly regulated accounting margin, known as GAAP, sitting at just 4.1%. But then their internally adjusted non-GAAP margin is looking a lot healthier at 15%. Now, an 11-point spread like this is super common in tech reporting, but we're never just going to blindly accept the feel-good adjusted number without asking, what exactly are they excluding? So, to bridge that gap, let's look at what management actually pulled out. They primarily backed out over $34 million in non-cash stock-based compensation for employees. They also excluded a little over $6 million in internal system transition costs because they're upgrading their own ERP and CRM tools right now, along with some non-recurring professional fees. Management argues these don't reflect the daily cash reality of running the business, which leads us directly to the metric that actually does.
Looking past those accounting adjustments, they generated a really solid $43 million in non-GAAP free cash flow this quarter alone. And by the way, that's up from just $16 million in the exact same quarter last year. Cash flow is the ultimate truth teller, isn't it? It's the real money left over after the bills are paid to buy back stock, acquire competitors, or just weather a stormy economy. Pulling in $43 million in a single quarter shows some serious underlying cash generation.
Finally, Part 5. Future Financial Outlook.
So, what's on the horizon? Their guidance maps out a really strong trajectory, aiming for up to $1.27 billion in revenue for the full fiscal year 2026. We just went over the $318 million actuals for Q2. For Q3, they're guiding slightly flatter, somewhere between $309 and $314 million, which totally tracks with normal enterprise seasonality. But that long-term target, that proves they expect this market share capture to keep right on rolling.
And here's a fun little sneak peek. Very recent Q3 headlines show they might be doing a lot more than just meeting that guidance. Early reporting indicates Q3 revenue jumping 11%, and that all-important SaaS ARR growth accelerating even further to 29%. This heavily suggests the momentum we mapped out in Q2 is actually compounding as they move through the year. Which leaves us with the million-dollar question. As supply chains completely shift and AI networks become the absolute standard, can this challenger keep stealing the crown from the industry giants? I mean, they've clearly got the operational leverage, the massive SaaS growth, and the enterprise wins. But in tech, standing still means falling behind. Keep a close eye on their SaaS ARR over these next few quarters. That is going to be the ultimate barometer of their success. Thanks so much for joining me for this explainer, and I'll catch you in the next one.